All right, welcome to our session today, ladies and gentlemen. As we continue with the standard costing, to just go back a little bit, if we remember last week, we said that standard costing can be considered to be one of the tools that can be used for controlling, whereby we can compare our standards or budgets to the actuals and see the problems that happened from our actual performance. Just like you, maybe you've got your New Year's resolutions when you started 1 January 2023. Then on 31 December, you just take stock of what you did during the year. Then you check if there are any differences between what you were planning to do and what actually happened. Then you see what corrective action that you can be able to take. Right. So now, let's continue from where we left off last week. Let me just close some tabs. All right, we dealt with the question 1. So today we want to deal with question 2. Then maybe when you have time on your own, you can deal with question 3. But on question 3, you can do the other parts that we've done, but my main focus would be that you can do this part here. So this is the part that I want you to do. That is DC up to F. You will do it on your own, maybe after we have done with this class. Right. So now we're going to deal with question 2. A South African company, Soda Limited, currently makes use of a standard absorption costing system. The costing system is now under review by the newly appointed cost accountant. He has started preparing a statement that reconciles the budgeted and actual profit of Soda Limited based on the information supplied below. He needs your help, however, to obtain the missing figures. Right? There will be some few ratios that will be affected by whether we are using the absorption or marginal or direct costing. Most of the ratios actually they are the same whether you apply direct or absorption costing, but we'll have a few ratios that will differ between direct and absorption costing. So I will be able to give you information on those. Right. Then the following budgeted data relates to the production of product soda for November. The product gets manufactured by mixing 2 types of raw materials, so and da. Right. Raw material input, there's so, there's da, then there's the raw material cost per kg. So you can see that the meaning of that is for so, to manufacture 1 unit, they need 0.4 kgs of so and 0.6 kgs of da. Then each kg costs 6 rand and 16 rand. That means the total cost per unit is the one that we're given here. Right. The yield is 96%. When they say yield is 96%, it means about 4% of the raw materials will be lost in the production process. So that means if our input is right, right. So when they say yield is 96%, it means there will be a loss of 4%. That will happen. Loss of 4% that will happen on the inputs. Right. So now let's move on and check what is our required, right? So this one is these are the standards. And the standards, normally they work hand in hand with the budget, because the budget is created from standards. I think last week we talked about the issue that the budget is not necessarily the standard. So but the budget is created using standards. All right, then this is the budgeted data that we have here. Then we have got below the actual data. Then down here we've got the actual. All right. Now complete the statement that reconciles the budgeted and actual profit for product soda for November. Show the missing variances as set out below. Right, this is what we call a reconciliation. A reconciliation reconciles the budgeted profit to the actual profit. So those things that those variances are the ones that cause a difference between the actual and the budgeted profit. So that's the purpose of a reconciliation. Right. So the question is, we should answer and get all those things that have got question marks. Right. But for the sake of understanding our things, some of the things that are given, we might also have to calculate so that we can be able to know how they were obtained. Right. So we'll start from the top. They want the budgeted profit. Budgeted profit, that's budgeted sales less budgeted cost of sales, that is production costs. Then right, for us to get the budgeted profit, we need to get these sales, budgeted sales, and we need to get the budgeted production cost. Right. These have nothing to do with variances. Calculating budgeted sales has nothing to do with variances. We know that budgeted sales, you just have to take your sales units if they are given times the selling price. If they are not given, then they should give you data that helps you to determine them. Right. So if we go back to the budgeted data, so basically what we're doing here is we're dealing with budgeted data. Right. So first of all, let's determine our budgeted sales, our budgeted cost of sales. Right. Our budgeted sales, on our budget data, they are budgeting, this is the budgeted data so that you can see this is budgeted data. They are budgeting to sell 72,000 kgs. And the selling price per kg is given here, that is 22. So at the end of the day, that means my budgeted sales will be the multiple, I would have to multiply the two. I will simply have to multiply the two figures to get my budgeted sales. Right. So we would say they don't have numbers, so I will just be answering here. So when you get this, you just be using the title to know that this question is for this and that this one is for that. Right. Our budgeted sales would have our budgeted sales volume, multiplied by the budgeted selling price. Right. So we know that they will be selling 72,000 kgs multiplied by the budgeted selling price we get is 22. What do we get?
$1,584,000.
Thank you so much. 1,584,000. So these are the budgeted sales. I want you to see something here. I started from the budgeted sales because this box tells me that this budgeted profit is coming from that box. So there's no way that I can start with the budgeted profit without getting the budgeted sales and the budgeted cost of sales. So that's the reason why I've started from the what? From the budgeted sales. So when we get these things, then we can go back and calculate this one. Right. Then our budgeted production cost. We know that a production cost, that's one of the things that can differ between absorption and marginal costing. Right. We know that using absorption and using absorption costing, we include both variable and fixed production cost when calculating our product cost. So we'll have to find out what was the cost per unit. Then we multiply by the number of units produced. Is that right? And you should be very careful there. I think some students, they always make a mistake of using the sales, or either they use the sales units throughout when determining the total cost and total sales value, and or they will use the production cost throughout. You should know that when you're calculating sales and what is selling expenses, you use the sales units. When calculating the sales and the selling expenses, use the sales units. Then when calculating production costs, you use the production units. Right. So here we have to go and get what is our budgeted production and what are the costs per unit, both variable and fixed costs. Right. If you get here, we are given the cost per unit, and the standard cost per kg is 12.90. Remember, I said that the standards are the ones that are used to create the budget. So you should know that the standards are used to create the budget. Right. So what we're going to do, we'll take this 12.90 and then multiply by the production units, which is 70,000. We take the production cost per unit and then we multiply by the units produced. Right. If we're using a direct costing, that means we're not going to include this fixed manufacturing overhead. Actually, it's surprising that they don't have direct labor. They only have raw materials. So if it was direct costing, instead of using including the fixed overheads, we're only going to include direct manufacturing costs. That is, we're going to include the direct labor, raw materials, variable production. Those are the things that we're going to include. Right. Right. So let's multiply this 12.90. So we'd say our budgeted production cost would take our standard cost per unit, production cost per unit, multiply by the standard, the budgeted production units. So then we're going to say of 90 multiplied by 70,000. What do we get? 903,000. Right. So that will be our budgeted production. Then the next thing, we need the budgeted cost of sales. We know that cost of sales when we are using would be then opening inventory plus budgeted production costs minus budgeted closing inventory. Our normal cost of sales calculation. If they wanted the actual, that means we're just going to replace the budgeted with the actuals. Right. The opening inventory we're given is 25,800. Then we have to determine our closing inventory. All right. This is our budget. So let's determine our closing inventory units. We know that closing inventory, whether you're using actuals or budgeted, is equal to opening inventory plus production minus sales. That is in units. We're not saying in value, in units. Right. We know that our opening inventory here we're given that is 2,000. Our production is 70 and our sales is 72. So we'd say 2,000 plus 70,000 minus 72,000 will get 0. So we don't have a closing inventory. So that means our budgeted cost of sales would be equal to the budgeted opening inventory, which were given 28,000 plus the budgeted production cost, which we calculated up the 903,000. What do you get? No, I took the wrong. I took the wrong 28,000 here. It's 25. The opening inventory. I took the fixed. Is 25,800. This opening inventory here. 25,800 is given here. Then the 903 we calculated it above. So this is 25,800. Can we correct this one? What do we get? 877,200.
We are adding.
I think it's supposed to be more, not less.
Supposed to be more.
It's 9 what? 9 to 8,000. Thank you. Is it 9 to 800?
Yes, it's 9 to 800.
Thank you. Right. So that is our budgeted cost of sales. All right. Then the budgeted profit. In this question, we don't have selling and distribution costs. So your budgeted profit will simply be your budgeted sales minus budgeted cost of sales. So it will just be equal to the gross profit. Right. So we have our budgeted profit. Let me just mention that there are no operating expenses. Normally we would know that it would be the sales minus cost of sales, then minus operating expenses. So we'll take our budgeted sales minus budgeted cost of sales. Right, our budgeted sales, we have calculated it above there. We know it's 1,584,000 minus our budgeted cost of sales. We calculated it above there again, 928,800. What do we get? $655,200. Thank you.
$655,200.
Yeah, I think I've already recorded that. Thank you so much. Then now, this budgeted profit is different to the actual profit because of variances. So now we have to now calculate the variances here. Now, in this column, you'll be showing the variance. Then you will show here in this column whether it's favorable or adverse. Right. If it's favorable, that means the question marks in this column is for an F or an A. Then in the first column, it's your the amount. Right. Sales margin price variance. Sales margin price variance. Right. Would say right, this one, the easier way to just calculate the sales margin price variance would be to say actual selling price minus budgeted selling price. Multiply by the actual quantity sold. Right. So we have to go and check our items that we need to use. we know that the budgeted selling price was 22. The actual selling price we're given here is 23. So they were budgeting to sell at 23, but they bought it of 22. Right. Would say 23 minus 22. Multiply by the actual sales units, 71,000. What do we get? I think that would be 71,000. And that is favorable. So let's go to the next one. Any questions there? Then the next one, sales margin volume variance. Right, a sales margin volume variance it arises because the volume that we sold was different to the one that we had budgeted. The price variance, I think, or I didn't explain that. The price variance arises because the actual price that we sold goods was different to the one that we actually sold. I think you can check the notes that I gave you for the reasons. And I think from our previous class, we also talked about the reasons. Right. So here we have to go and check. Okay, let me just first give you the formula. That's our standard margin volume variance. Right, this one now. Right. This is one of the variances that I was telling you that they can be a difference between a direct costing and absorption costing. Right. Actually, let me just show you. So with the standard margin volume variance, this is the actual volume, actual sales quantity minus the budgeted sales quantity multiplied by the standard gross profit. If we were using direct costing, instead of multiplying by the standard gross profit, we're going to multiply by the standard contribution. So for this ratio, it differs whether you are using absorption or direct costing. So if using absorption costing, we multiply by the standard gross profit. When using direct costing, we would multiply by the standard contribution. So for this, you should check which one they are using. Right. So if we check here, our budgeted sales quantity was 72. Then the actual, okay, someone is saying contribution. What it is? Yes, contribution. It will be the standard contribution if we are using direct costing. Right. So our budgeted sales, it's 72,000. Our actual, it's 71. Then our budgeted gross profit, we know that our budgeted selling price is 22 minus our budgeted cost per unit, which is 1290. So we're going to say here, our actual sales $71,000 minus the budgeted sales 72,000 multiplied by the standard gross profit, which is the budgeted selling price of 22 minus the budgeted cost per unit, which is 1290. What do we get? I think I got the answer here. Thank you so much. 9,100 adverse. So it's adverse because we sold less goods than what we had planned. Remember that a budget you'll be planning, but it can happen that on the ground you might not sell as much as you would have planned. Right. So if it was direct costing, we're going to exclude this one. We're going to use the 1250, so it was going to be 22 minus 1250. Only the variable cost. Right. So that's the sales margin volume variance. Right. Then material price variance is given, but we need to calculate it so that we know how it is calculated. Right. I think we did it again last week. A material price variance arises because the price at which we bought the materials was different to the one that we actually bought our materials. Right. So maybe let me just do the calculation here. I'll leave my material price variance. Material. With so, with that. Right. Remember that this one is equal to standard price minus actual price. Multiplied by actual quantity purchased. Please note that on this formula, we don't use the actual quantity used in the production process. We use the actual quantity purchased. Remember that as long as they are keeping inventory, our materials used in production can be different to the ones purchased. As long as there is inventory, our material used can be different to the one purchased. So now we would say, so here we have our actual price. Sorry, standard. I would start with my standard price. Actual price. Difference. Actual quantity. Variance. Right. Our standard price. We are told that the standard prices are 6 and 16. Right. So those are the prices for so and da according to the standard. So we have 6 and 16. Then our actual prices for so and da they are given here 650 and 1580. 1580. Right. Then we have our difference. So that means on saw we paid 50 cents extra. We paid 650 instead of 6. On da we paid 20 cents less. We were expecting to buy for 16, but we bought for 1580. Then the actual quantity were given here. Right. The input here we'll just take the input because we don't have inventories of raw materials. That inventory that we have is not of raw materials, it's of finished goods. So in this question, we don't have inventories of raw materials. So as long as you don't have inventories of raw materials, the material used in the production process will be the same as the one that is purchased. So that's 29,900 and 4,100. Then our variance will multiply. So this is adverse, favorable. Then we get our total. So this is how we find our material price variance. So that's how these figures here are obtained. So that means at the end of the day, there was a favorable price variance on saw, but which was overweighed on da, sorry, which was overweighed by an adverse variance on saw, which led to an overall price variance being adverse. So this can be caused by buying from a different supplier than planned, or there can be inflation beyond expectations, which pushes up input prices, or there can be unrealistic budgets, as I said. And the favorable one can be because of discounts obtained for buying in bulk, maybe getting a cheaper supplier whom we identify after already doing the budget. Or we can use poor quality material. Right. Any questions on the material price variance? So please, in your tests and in your exams, sometimes they don't ask for both products. I think we saw when we were doing last week that they could ask for one product. So in your exam, first check which one are they asking. Don't just say the same material price variance, then you take all the materials, 5 of them on the question, you waste your time. Because they can say calculate the material price variance for so on. Or they can just say material price. If they just say material price variance, that means you have to do all the resources that are given. Any questions on that one?
Eugene,
Yes.
can I ask something? I just
Yes, you
want to
can.
find out. Yeah, I just want to find out. Let's say, for instance, in exam, they don't give us the structure, the structure that you are using now. Is this the if let's say they ask us to do the reconciling? Is this the
Reconciliation?
structure?
Yes, that's the
Yeah.
structure.
Is
That's
this
how you
the
do it.
structure? Oh,
Yes.
okay. Because
It's
I
only that
saw
maybe. Yes.
yeah, I'm saying I saw this question in our question bank, and then I didn't know how to do it because I was just practicing, and then this is the structure that we must use even in
Yes, you
exam.
start
This
with
is
your
how we.
budgeted profit, then you include all your variants. Like, but of course, this one does not have some of the things. For example, they can be direct labor, so you'd have to include the direct labor variances.
Okay,
So that's
sir,
the
thank you.
exact structure, but it's only that it doesn't have a few things that, like for example,
Yes.
it doesn't have direct labor. This
Yeah,
one does
because
not.
sometimes I saw that sometimes they don't give us exactly the same way you're showing us. But if we know the structure, we can just put the structure and then do the calculation according to the way you're showing us.
Yes,
now.
if they ask you to do a reconciliation, you have to do it. It's exactly the structure that is on the question there.
Thank you, sir.
Okay, thanks. Right. Next, material mix variance. Right. A material mix variance arises because the recipe that you used to manufacture your product was different from the plant. That is, the proportions of the raw materials were not according to plans. I think you guys, you cook. When you cook, you exactly know how much water you should put in your pot, the quantity of cooking oil that you should put there, the salt that should be in that meal, the quantity of meat you have to include, the vegetables that you need there. You have got quantities that you have to mix for your meal to be okay. That's the same in a production process where they use different raw materials. They exactly know the proportions that they should include for each raw material for them to produce the best product. I think some of you, there was a time that you cooked and you couldn't eat the food. You had to throw it away. Maybe it was your pap, then it didn't come out well. Why? Because the combinations of the resources was not the one that you should have used. I think we have had situations where there's too much salt because the resources have not been balanced. The quantity of the meat and the soup that is there and the salt that has been added do not agree with each other. That's why the food is not tasting nice. That's the same in a production process. You would find that you can affect the quality of the product if you don't combine your resources well. There is a recipe which determines there is a standard that, okay, when we produce this 1 unit of soda, it should have 0.4 kgs of soda and 0.6 kgs of gas for us to make 1 kg of soda. Is that right? For us to make a kg of soda, we need so 0.4 kgs, da 0.6 kgs. But now we can say that in the production process, maybe they were using 0.5 kgs of so and 0.5 kgs of da. then there's a material mix variance. So it is a variance that arises because the proportions of the raw materials that were actually used were different from what we had planned. Right. So we're going to say material mix variance our actual material in standard proportions minus actual material used multiplied by the standard price. Right. So say material, you will see what I mean when I do this. Right. We'll have our actual material in standard proportions. Then we'll have actual material in actual proportions. Difference. Standard price. Variance. Right. Now let me just calculate our actual material in standard proportions. So you take the actual material that was used in the production process and allocate it according to the proportions that were supposed to be used. Right, we know that they are supposed to use them in 0.6 s to 0.4, 0.4 s to 0.6. It's a coincidence that they are giving you one exactly. In another exam, it can be 0.4 s to 0.3 kgs. So it's not always that there will be one like this. Right, we know that the actual raw materials used, this is the input of raw material and of saw and da. So the actual raw materials used would be equal to 29,900 plus 40,100. What do we get? $70,000. Right. Then we allocate them in standard proportions. That means so would be equal to 0.4 over 1. 1 is coming from 0.4 plus 0.6. I'm doing it as a procedure because it's not always that it will always give you 1, like what is happening in this question. It's not always that it will give you 1. That's why I've just done it as a procedure to make sure that you know that you have to add the 2. So my 1 is coming from 0.4 plus 0.6. because they can give you that the other one requires 3 kg, the other one requires 4 kg. So you have to say 3/7 and 4/7. Right. So what do we get? Just a minute whilst you're calculating. I'll be back in a minute. $28,000. Thank you. Then that would be equal to 0.6 divided by 1 multiplied by 70,000. What do we get? 42,000. Right. Then we'll have 28,000, 42,000. Then the actual material in actual proportions. Then here we're talking about the actual usage that they did. 29. Okay, before I go to that, let me explain. What we're saying is, if in their production process, if they use 70,000 kgs, our expectation is that they would have used 28,000 of so and 42,000 of that if they followed the recipe that they are supposed to use those raw materials. So this 70,000 that they use, our expectation, if they do everything according to standard, is that they should use 28,000 of so and 42,000 of that if they follow the manual, right? But then actually they didn't do that. In the actual production process, they used the 29,900 of so and 40,100 of that. So that means there was some way they could follow the recipe as it is. So 29,900 and 4,100. So at the end of the day, then the variance, this minus this. So we're saying on so they used the 1,900 kgs more than they could have used. Then on that they used 1,900 less than they could have used. The one that is negative is the one that they used more, because they used 29,900 instead of 28,000. So it is shown as a negative because it's adverse. Is that right? But then on the DA, they used less of that. All right. Then the standard price, we know that the standard price of this raw material, I think we have them from our previous calculation. These are the standard prices here, 6 and 16. Then our variance will be the difference times the standard price. Then we get our total. This one is adverse. This one is favorable. This one is favorable. So these are the variances. 90,000. Then there's 30,400 and 11,400. So these are the figures that we're supposed to be here in our variances. So actually this one is favorable. Then we have to fill in the other ones here if you were doing the reconciliation according to our calculations. This one was already calculated, the 19,000. So that means our variance, you would find that your variance will always be favorable if you use more of the cheaper material than the more expensive material. So you find that the one that they used more was the saw, and the saw only cost 6 rand. Whereas the DA, which costs 16 rand, they used lesser. That's why their variance is favorable. But it's not always good to have a favorable material mix variance. Because as long as there's a material mix variance, that means you didn't follow the proportions that we expect. So that might compromise the product quality. In terms of amount, it will be good, we would spend less, but that might also reduce the quality of our product. Because maybe DA is the one, let's say, for example, DA is the one that strengthens the product, for example. Now, if you put less of DA, your product will not be as strong as the original. So that's why a material mix variance should not always be taken as, if it's favorable, should not always be taken in good light. We have to find out what is it. There are many favorable variances that can be questionable. For example, you can have a positive material variance because your purchasing officer went and bought from a friend who was selling for a cheaper, who deliberately put a cheaper price on the quotation and supplied things that are substandard. At the end of the day, our products on the market do not perform our sales, they will then reduce. So you find that you will have a favorable material price variance, but your quantity variance will go up because there will be a lot of wastage in the production process. Your sales variance, the sales volume variance will be adverse because your product will not compete on the market. Right. So this is how we calculate a sales mix variance. So a material mix variance arises because the proportions with which we actually used our raw materials were not in line with our expectations. Any questions? Right. Then we have material yield variance. Material yield variance. Right. Material yield variance. Input allowed for actual production minus actual inputs in budgeted proportions or in standard proportions. Times standard price. So the yield variance, it's a variance that arises because the output is sort of an efficiency measure, whereby there's an output that we expect from a certain quantity of raw materials. And if we don't get that output from the raw materials, that means there's a problem. So it's a question of what was the output that we're expecting and what was the output that we actually got. Right. So we have material, right, input allowed, actual production, what did I do here? Sorry about that. I made a mistake. Right, we have our input allowed for actual production. Then the actual inputs, standard proportions. Then the standard price. Sorry, difference standard price. Variance. All right. So first of all, let's calculate our input allowed for production. So that means for the actual production, what were the kgs of so that we're supposed to use, right? According to the budget, there's one thing that you have to take into account. We know that according to the budget, they were supposed to use 0.4 kgs of so, and the actual production was 69,000 kgs. Each kg required 0.4 kgs of so, but you should be very careful if there's a loss. You also have to take that loss into account. That means they have to put more raw materials because 4% will be lost after the production process. So to get the raw materials, if there is a loss like this, right? If there was no loss, we're simply going to multiply the 0.4 times the 69,000 production to get the input that is allowed. But now the input allowed is more than that because they have to also cut off the normal loss, right? So we would say 0.4 times 69,000, but then we divide by 96%. What will we get? So the 96% is the yield. So you divide by the yield to get the actual input required. This is so that you can also include the wastage in your raw materials. Because if you don't include the wastage, then remember you won't get the output that you want. So you should actually put more resources in your production. If you need 10,000 units, you don't have to put inputs for exactly 10,000. Because if you do that, at the end of the day, you're going to get less than 10,000 because 4% will be lost. So you have to put more input so that when the 4% is lost, you get what you actually need. Right. So what do we get? 28,750. Then down, we do the same. This is 0.6 multiplied by 69,000. Then we divide also by 0.96. That is equal to what? $43,125. Right. So that means this is 28,750 and 43,125. So these were the inputs that they were supposed to use in the production process after taking into account the normal loss. Right. Any questions there? Right. So would say the actual input in standard proportions is this one here that we calculated, the 20,000 and the 42,000. That's the actual material in standard proportions. Then the difference so they were supposed to use 28,750, but they only used 28,000. Right. Then our standard price, we know that it's 6 and 16. Then our variance, we multiply. Right. Then that's favorable. Right. So this will be favorable because we got a more input than what we expected from the resources that we applied. You will have obtained more input than what you expected. Right. So these are the answers that will come here as your material yield variance. Right. Any questions? If we don't have any questions, then we'll move on. Then the fixed overhead expenditure variance. I think we did this one. We did it last week. Right. Would say fixed overhead expenditure variance.
Sorry, Mr. Eugene.
Yes, my boss.
Yes, please explain again. How do you determine the variance there by the yield? Please go up.
Yes.
The 4,500 and the 18,000 variance. How do you determine that?
Multiplication of the
it's,
difference times the standard price.
Yes, I understand you multiply by but how do you determine that it's favorable or adverse?
Yeah. The input that you were allowed was you actually used less. You were supposed to use 28,750, but you only used the 28,000 to get that yield that you got. According to the standards, you were supposed to use 28,750 kgs of salt, but you only used the 28,000. You were supposed to use 43,125, then you only used 42,000.
So basically you used less
than
to
the input that is allowed.
Oh, okay.
Right.
All right.
Fixed overhead expenditure variance is the budgeted fixed overhead minus actual fixed overhead. Right. Here, our budgeted fixed overheads, they were 20,000. And the actual was 27,800. So left 20,000 minus 27,800, which is 200 favorable. You expect to spend 28,000, but you only spent 27,800. Right. Then the fixed overhead volume variance. This arises because the volume of activity that you were expecting to actually use was different to the actual that you used, right? But now to find that activity, you have to first find out how are they absorbing overheads. Because if they are over absorbing according to units, we should use the units. If they are absorbing according to labor hours, we should use the labor hours. If they are absorbing according to machine hours, we should use the machine hours. So you have to first find out what is the cost driver in that particular company. All right, if we go back, let's see how are they absorbing overheads. It seems as if they are using kgs of output. So that means it's per unit, 0.4 per unit. They could have said that it's 0.4 per labor hour, but this is the kgs of output. So that means it's according to the number of units. So you can say fixed overheads, volume variance, actual activity. I'll use the word activity because it would depend on the cost driver minus budgeted activity. Applied by the standard fixed overhead rates. Right, which is the actual activity. The actual units was 69,000. We'll be talking about the production because fixed overheads are in the production process. The budgeted was 70 and the standard was 40 cents per unit. So would say 69,000 minus 70,000 multiplied by 0.4. What do we get? $400 adverse. Right. Actual profits, but we need this one. Opening inventory. Opening inventory does not change, isn't it? We are given. That's with the 25,800. There's nothing to calculate there. There's nothing to calculate on the opening inventory. So the opening inventory is 25,800.
Sam,
Yes.
the formula for fixed overheads volume variance, doesn't it start with the budgeted activity minus actual activity?
This one is fine as it is. Because what happens is with fixed overheads, remember they don't change as the level of activity changes. So if you produce less, that's unfavorable because lesser inputs will now have to absorb the overheads. Remember that if lesser units absorb overheads, the fixed overhead per unit will go up. So that's why it's good as it is. I think it's one of the it's I think the only ratio that goes away from those ones that I told you, that general rule that I said for cost you start with the budgeted, then for sales you start with the actual. This is the only one that is that is odd because of its nature. The lesser the units that you actually produced, our fixed overhead, remember that fixed costs do not change. Our fixed costs will remain as, if they're 100,000, they will remain as 100,000. So if we're planning to produce 10,000, it was going to be 10 per unit. But if we produce 8,000, it will now be 12.5 per unit, which is adverse. So it's actually adverse if we produce lesser, if our activity is lesser than what we had planned. That's why it has to be like that.
So, but Mr. Eugene, you said that it does not matter in the brackets if we swap them around.
Yes, but as long as you understand that it will be adverse if you do this. The way that I put them, I just do that in these ways to avoid confusion. If you know how to interpret it, then that's fine. If you
Yes.
don't like, but I put like the advantage of putting them in the way that I'm putting them is that maybe sometimes you have pressure in the exam and you get a negative answer, you just say adverse. So it doesn't matter, but as long as you, at the end of the day, if you say 400 adverse, that will be fine. But if you put it in this way, you know that if my answer is positive, it's favorable. If it's negative, it's adverse. That's the advantage. But you can put it in whatever way, as I said last week. What is key now at the end of the day, if you are putting it the other way, you should be able to understand that when is it adverse and when is it favorable. Right.
But in this case, doesn't Mr. Eugene, in this case, doesn't it mean that we spend less than what we
No,
budgeted
the spending is not the spending. It's not about spending here. The fixed cost, remember, they don't change. The volume variance is about the units that have to absorb that cost, which is not changing. If you understand that. Volume variance does not talk about the expenditure. The expenditure is dealt with here. Is that right? Here we're talking about the volumes that you have to absorb that overhead that we have. So if you produce lesser, you now have lesser input units absorbing that same overhead. So the cost per unit will push up. Remember that fixed cost per unit will go up as long as your production reduces.
Okay.
From our first topic. So actually, when you have lesser activity, that's when it becomes adverse. Because you now have lesser activity units absorbing the same cost. If your production goes up, the cost per unit will go down, which will be favorable.
Oh, all right.
Right. Then the actual profit, we have actual sales revenue. So, right, DA is the raw materials of DA. DA, we know that we bought from, sorry, I think our DA, we are on the actuals now. We purchased at 1580 and we purchased 40,100 kgs. So our DA would be equal to 1580 multiplied by 4100. What do we get? 633.58. And you put it, this is a cost, so you put it as a negative. The opening inventory, I think I've put it already. Then we can get our profit. You just take this, then minus these production costs that we have. So our actual profit is the 1,633,000 minus 194,350 minus the one that we calculated there, 633,580 minus the fixed overheads, which are given 27,800 minus our opening inventory, which is 25,800. What do we get? 751 for 70. Any question? Right. If we don't have any questions, that will be the end of our class. So please, can you try to do question 3? Next week, I think I'll move on. I think I need to deal with transfer pricing and performance management. Thank you so much. God bless you richly and enjoy your evening.